Let's analyze a publicly traded company's income statement to get a better idea if the company is worth investing in. When investing in companies for a long period of time, say over a year, you want to make sure you do your research in analyzing the potential investment. The approach that we'll be going over is more of a value investing approach. We're basically trying to find an investment that has a durable competitive advantage. In other words, a company that is stable, consistent, and is an industry leader. There are different financial statements that you should look at when investing. We'll be covering the income statement in this video. First, we'll briefly go over how to read the income statement, and then we'll go over different ways to analyze the income statement. To find a company's income statement, you can go to the sec.gov website and you put the ticker symbol of the company you want to look at. We'll go ahead and put Target, TGT. Then we go to the filing type. We're going to go ahead and put 10K. That's the name of the report. And you can see the last 10K that they filed was in 2019, which reported the prior year, which is 2018's number. So you click there, you go to the 10K, click on the document, you scroll down to the table of contents, and line 8 is usually the financial statements. You click there and you scroll a little bit down and you can see the income statement for Target for the past 3 years. The income statement tells you the company's performance over a period of time, say over 1 year or 3 months. The three main sections to an income statement are the revenues, that can be referred to as the top line, expenses that the company has, and at the bottom, the profit or net income, which can be referred to as the bottom line. Let's start at the top with revenues, cost of revenues, and gross profit. Consider the revenues of a company to be their primary money stream. This is where all the sales are listed. For example, a company like Target will list all their store sales in this revenue section. So when someone buys an item from Target for $20, those $20 will be reported in the company's revenue. The next line is the cost of revenues. Think of this as the primary expenses of a company. There are the costs a company has in order to generate its sales. Back to our Target example, when you purchase that item for $20, Target might have paid $15 to buy that item and then sell to you at $20. And that $5 difference is known as the gross profit, which is simply the difference between revenue and the cost of revenue. This is the money that a company makes when they sell a product. Now, the gross profit isn't listed here on the income statement, but we'll include it when we begin our analysis. Moving on to the second section, we have the operating expenses. Now, different companies will have more items in this section than others depending on their business model. For example, Intel, a computer chip maker, will have research and development costs in this section. For our example, Target only really has selling and administrative expenses, which include store manager salaries, store utilities and insurance, marketing, and depreciation. Think of these as secondary expenses. Lastly, we have the profit section. Here we can see a company's operating income, other income/expenses, and the bottom line. Operating income is the gross profit minus the total operating expenses, and it shows how much money a company is generating from their regular day-to-day operations. In the other income/expenses, you can see interest income from investments that the company has and or gains and losses from selling company assets. Now, these two items are considered other income/expenses because they're not part of the company's day-to-day business operation, or it's not part of their business model. For example, Target is not in the business of earning interest like a bank would, or it's not in the business of selling pallet jacks like a manufacturer would. Next, we can also find the interest expense. These are the interest payments a company is making on their current debt. This is considered a financing expense, not an operational expense. That's why it's listed on this section. And finally, we have the bottom line or the net income. This is the line that shows the amount of money that the company made or lost overall for the time period given, either for the full year or for the past 3 months. Alright, now we can go ahead and start doing some financial analysis of the income statement and compare it to other companies in the same industry. Now I went ahead and I created a Excel sheet with Target's income statement and Walmart's income statement. I got these income statements from Morningstar. I just exported the income statement that they provide, and then I made a couple changes and I separated them into the three sections that we talked about. To start the analysis, I like to start in the gross profit margin. Now this is taken by dividing the gross profit divided by the revenues. Now this shows me for every dollar in revenues the company has, how much of that dollar is actually kept by the company. So the gross profit margin of Target is around 30% for 2018. So for every dollar in sales that they have, they keep around 30 cents. Next, I like to look at the operating margin, which is basically the operating income divided by the sales. Now, similar to the gross profit, it tells you how much money the company gets to keep from every dollar in sales. But unlike gross profit, operating margin accounts for operating expenses. So essentially, this is what the company is able to keep after the cost of revenues and all operating expenses. Next, I like to look at the profit margin, which is the net income divided by the revenues, which gives me the amount that the company gets to keep after every expense, after operating expenses, after cost of revenues, after all interest and other income/expenses. Next, I like to look at the interest coverage ratio. Now, this to me is a very important ratio. This takes the operating income and divides it by the interest expense. So the operating income is the income that the company generates from its day-to-day business operations, and the interest expense is a financing expense that is not included in operating income, but it's an expense that the company has to make on the debt that they carry. So for Target in this scenario, they have an 8.92 ratio in relations to operating income and interest expense, meaning they have 8 times more in operating income than in interest expense, which is great. Now, if this ratio was, for example, 1 or less than 1, it would show that the company is losing a big portion of their operating income to interest expense. And that will hurt a company over the long term, and it could even cause bankruptcies. So this is a very important ratio to take a look at. You want this ratio to be as high as possible. Next, the next 3 categories I have is the growth in sales, operating income, and earnings. So this takes the growth rate from 2017 to 2018 and so on and so forth for the prior years. Sales growth should be consistently growing for a company that is expanding and is growing, or if a company is at its matured state, these sales numbers will typically be somewhat stagnant. In case of Target, they've kept it around 1 to 3% growth, and they had a down year in 2016 where they lost 5% in revenue. But for the most part, they've been consistent with the revenues. Now for operating income, the income that they're generating from day-to-day business operations, they've seen slight declines and a huge decline in 2017 of 13%, which if we take a look here, we see that they've typically spent around 14 billion in selling and administrative expenses, and it jumped to 15 billion and 15.7 billion in 2018. So that's something to take a look at. And then lastly, we have the earnings growth. You want a company to show strong earnings growth over multiple periods of years. Target had a huge growth in 2015. Now I'm taking the net income from continuing operations because in 2014 they had a huge loss from a side of their business that they discontinued, which you can dig more into that in the annual report for 2014. But needless to say, they grew their income by around 37%, but then in 2016, 17, and 18, they've kind of slowed down with a huge drop in 2016. Now, once we have this analysis for the income statement for Target, we can go ahead and compare it to another company and in the same industry, which I have Walmart. Now, I did the same exact analysis for Walmart, and let's actually Okay, so I was able to put the analysis of Target that we did on the top and the analysis for Walmart on the bottom, just to compare both companies. Now, we could actually see that the gross profit margin, operating and profit margin for Target is actually stronger than the ones of Walmart. And if we take a closer look at the profit margin, we see that Walmart has actually been declining in profit margin for the past 5 years, while Target has either increased or stayed close to around that 4%. Next, we can go ahead and look at the interest coverage ratio, which for both companies was around 9. And honestly, an interest coverage ratio of about 5 or 6, that's more than enough. So these two comparisons are fairly the same. And then we have the sales, operating income, and earnings growth. As we can see for Walmart, their sales growth has been pretty much stagnant, been consistent over the past 5 years, which is expected for a company like Walmart. And so has Target, with just a slightly more of a jump in revenue for Target. So Target has a little bit more potential moving forward, or is showing a better potential moving forward and increasing their sales. Now, for operating income growth, it's pretty interesting because both companies had a huge decrease in 2017 in their operating income, 13% for Target and 10% for Walmart. But in 2018, Target lost 3%. Meanwhile, Walmart was able to figure out what was going on and what was going wrong, and they were able to increase their operating income by 7.4%. And lastly, we have earnings growth, which for Target, they're kind of a little bit over the place, except for the last 2 years, they've shown slight growth. They had a huge decrease in 2016. However, Walmart is showing slow signs of earnings growth, losing 10% in 2015, another 7% the following year, 27% in 2017, and 32% in 2018. Now, these numbers look very bad for Walmart, but you would have to look in a little bit deeper, because the sharp decline in earnings growth is not being represented from their sales or operating income growth. As you can see, their sales are growing and their operating income is growing. So why is their earnings growth seeing such sharp declines? Now, that could be somewhere in the profit section, which if we go to Walmart, we can see that they have huge losses in other income/expenses of $8 billion in 2018 and almost $3 billion in 2017. So with this information, you would want to take a closer look of what's going on in this other income. Are they making certain purchases that's costing them money? Are they acquiring other businesses? And what's the outlook looking for Walmart in the future? So that's basically a analysis that you can do using the income statement for two companies. You can go ahead and compare them and see which one is a better investment. There are other financial statements that you should consider, like the balance sheet and the statement of cash flows, but I think the income statement is a good place to start for beginners. Hope the video helps, and thanks for watching.